Welcome to this explainer. Today, we're throwing on our professional equity analyst hats to run a rigorous, absolutely no-nonsense stock valuation of telephone and data systems, or as it's commonly known, TDS. We are going to evaluate this company strictly based on the raw financial data, completely stripping away the market noise to find its true intrinsic value.
Okay, let's dive into this. Right now, based on our data snapshot, TDS is sitting at a stock price of exactly $44.97. That's our starting line. And when you see a price tag like that, the immediate reflex of any good analyst is to question it. Is the market actually pricing this correctly?
Which brings us to the core mystery of our explainer today. We need to figure out if this $44.97 represents an undervalued gem hiding in plain sight, a perfectly priced fair market value, or an overvalued bubble that somehow defined financial gravity. And to answer that, we can't just guess, right? We've got to run the numbers.
To do this properly, we're going to run through the standard analyst's toolkit. We'll kick things off with a baseline snapshot. Then we'll hit our three valuation pillars: absolute models, relative comparisons, and an asset-based valuation. Finally, we'll synthesize the whole thing into a final intrinsic value range. Let's get to it. All right, part one, the baseline snapshot. Now, what's really interesting about this slide is the wild contradiction we're seeing right out of the gate. Over the last 3 years, TDS boasts a massive 403% return. I mean, that looks like a huge win. But look right across from it. The trailing 12-month net income is negative $74.89 million. The company is literally losing money on the bottom line, yet the stock price has just absolutely soared. This is a massive red flag that basically demands deeper modeling.
Moving right along to part two, absolute valuation models.
Here's where we try to find the intrinsic value of the company, based purely on its own ability to generate cash. We are completely ignoring what the rest of the stock market is doing right now. Our heavy hitter for this is the discounted cash flow, or DCF model. The logic is super simple. A company is only worth the present value of the cash it can generate in the future. Step one actually looks solid. TDS has a trailing free cash flow of over $151 million. Step two is projecting that out, and step three is discounting it back to today's dollars using the company's weighted average cost of capital.
Of course, in the real world, you rarely get all the answers handed to you. Our source documents give us the current cash flow, but they don't give us management's exact 5-year projections or the precise discount rate. So to complete the DCF, we've got to plug in some sensible industry defaults. We'll assume a conservative terminal growth rate of 2 to 3%, which totally makes sense for a mature telecom market, and apply a standard market risk premium of 5 to 6% to figure out our discount rate.
Well, our source data actually ran the complex math for us based on those inputs, and it explicitly reveals a modeled fair value price of exactly $20.66. Hold on to that number, because it is literally less than half of the current trading price. But before we lock in our absolute valuation, we really should check a couple of other standard models. Now, you might be wondering, what about the dividend discount model? Well, TDS has a tiny dividend yield of just 0.36%, and its 3-year dividend growth rate is actually negative 39.9%. The DDM formula completely breaks down there. It's just way too fragile. What about the residual income model? Well, because TDS has that negative net income of almost $75 million, projecting positive residual income is a major stretch. So our DCF value of $20.66 stands as our absolute anchor. Okay, let's pivot to part 3. Relative valuation comparison. If absolute valuation is looking in the mirror, relative valuation is looking out the window at the neighbors. How does TDS stack up against similar companies? Now, our source documents don't hand us a neat little list of peers, so we apply the show your work method. In the telecom sector, we're benchmarking against giants like AT&T or Verizon. Typically, mature capital-intensive telecoms trade at single-digit price-to-earnings ratios and an EV to EBITDA multiple somewhere around 7 or 8. We're going to use that as our baseline to contextualize TDS. And honestly, when you line TDS up against those standard telecom metrics, the numbers are pretty brutal. TDS is rocking a forward PE of 39.06, its EV to EBITDA is over 11, and the price to free cash flow is a staggering 34.07. Remember, standard peers might trade at a fraction of these multiples. The market is paying a massive premium for TDS compared to typical sector valuations, heavily signaling that it's overvalued on a relative basis. Which brings us to part 4, asset-based valuation. So, if the earnings and cash flow don't justify the price, we've got to ask, do the raw assets make up for it? We're looking for the net asset value, or NAV. In a perfect world, we'd go line by line through the balance sheet, adjust real estate and equipment to fair market value, and subtract the liabilities. Since our raw data dump doesn't give us those individual line items, we'll use the provided financial ratios as proxies for the health of the balance sheet. And this brilliantly illustrates our point. Look under the hood here. The price-to-book ratio is 1.07. That means the market cap of $4.78 billion is trading almost exactly at the accounting value of its net assets. If the price is around $45, the implied book value per share is roughly 42. Plus, with a very low debt-to-equity ratio of 0.17, the balance sheet is surprisingly clean. So the asset-based valuation actually suggests the company is priced fairly relative to what it physically owns, even if its earning power is incredibly weak right now. Finally, part 5, our final intrinsic value synthesis.
All right, it's time to bring all three of our pillars together and make a final call on that $45 price tag. Let's look at them side by side. Our absolute DCF model spits out a hard value of $20.66. Our relative valuation shows the stock is severely overvalued compared to its peers. And our asset-based NAV model shows it's trading essentially right at its book value. You catching the pattern here? Absolutely none of these fundamental models support a growth narrative that would justify buying the stock at $44.97 today.
In fact, our source data calculates a specific metric that basically sums up this entire analysis: margin of safety. And for TDS, it is a devastating negative 117.66%. In value investing, you want a positive margin of safety, meaning you're buying the stock for less than its intrinsic value. A deeply negative number like this implies the stock carries immense downside risk if market sentiment ever decides to, actually align with the financial data.
So the crucial point is this massive canyon you're seeing between the current market price of almost $45 and the modeled fair value of roughly 21. The market is clearly pricing in some incredible future growth, or maybe anticipating an acquisition premium, but the fundamental day-to-day cash flow and earnings math, it simply cannot justify it. Which leaves us with one massive, lingering question. Is that stunning 403% three-year return a true telecom miracle, or is it an overvalued bubble just waiting for reality to set in? As an analyst, the numbers tell a really clear story of overvaluation. But hey, the market can remain irrational for a long time. Keep questioning those stock prices, keep running your models, and never take a price tag at face value. Thanks so much for joining me on this explainer, and I'll see you next time.